Gilts are UK government bonds. When you buy one, you're lending money to the government. In return, the government pays you interest, called a coupon, usually twice a year. At the end of the bond's term, the maturity date, you get your original investment back. Gilts are popular for their steady, predictable income, making them attractive for those seeking stability. They come in different lengths: short-dated, a few months or years, and long-dated, up to 30 years or more. Generally, the longer you lend your money, the higher the coupon rate to compensate for risks like inflation. You don't have to hold a gilt until maturity. You can sell it on the market, just like shares. The price you get depends on interest rates. If rates fall, your gilt could be worth more. If they rise, it might be worth less. This flexibility means you can exit early if your needs change. Gilts are straightforward, but their value can fluctuate with the market. They're a simple way to lend to the government and earn regular income. Understanding gilts is the first step to making smarter, more secure investment choices. Gilts are seen as one of the safest investments because you're lending to the UK government. The risk of the government not paying you back is extremely low. They can raise taxes or print money if needed. This makes gilts a go-to option for cautious investors, especially during market turmoil. When stock markets are volatile, investors often move money into gilts for security, a flight to quality. However, gilts aren't risk-free. The main threat is inflation, which can erode the real value of your returns. If inflation outpaces your coupon, your money loses purchasing power. Interest rate changes also affect gilt prices. If rates rise, existing gilts with lower coupons become less attractive and their prices drop. If you hold a gilt to maturity, you'll get your original investment back, regardless of market swings. Selling early could mean a loss if rates have risen. Gilts are about preserving wealth, not chasing high returns. They're a cornerstone for those who value safety and predictability. Always weigh inflation and interest rate risks before investing. Gilts offer a unique tax advantage for higher rate taxpayers. While coupon payments are taxed as income, any profit from selling a gilt or from its price rising to face value at maturity is free from capital gains tax. This means you can keep all your capital gains, unlike with shares or property. Savvy investors often target low coupon gilts trading below face value, maximizing tax-free gains at maturity. For example, buy a gilt for £80 with a £100 face value. You pocket the £20 gain tax-free. This strategy is especially useful if you've maxed out your ISA and pension allowances. Gilts can be a powerful tool for tax-efficient investing outside traditional wrappers. Understanding this benefit can significantly boost your after-tax returns. Don't just focus on the coupon rate. Look at the yield to maturity for the real picture. Yield to maturity combines the annual coupon, any capital gain or loss, and spreads it over the bond's life. For example, a gilt with a low coupon but a big discount to face value can offer a higher yield than it first appears. For higher rate taxpayers, calculate the post-tax yield to maturity. Tax the coupon, but not the capital gain. This gives a true comparison between gilts. Many investment platforms show these figures, making it easier to choose. Yield to maturity is the key number for smart investing. It blends income and growth into one clear percentage. Always check this before buying. It's the best way to compare your options and maximize returns. Buying gilts is easier than ever for individual investors. The simplest way is through major DIY investment platforms like Hargreaves Lansdown or AJ Bell. Just log in, search for gilts, and place your order, similar to buying shares. Watch out for trading fees and annual platform charges, as these affect your returns. Alternatively, you can buy directly from the UK Debt Management Office via Computershare, but this involves extra paperwork and its own fees. For most, using an investment platform is quicker and more convenient. Compare costs before you invest. For small amounts, platforms are usually the best starting point. You can buy gilts as new issues or on the secondary market. New issues are sold at face value and offer current market coupon rates, but most returns are taxable as income. The secondary market offers a wider choice. Older gilts with low coupons often trade below face value. These discounted gilts can provide attractive tax-free capital gains for higher earners. Shopping the secondary market lets you tailor your investment to your tax needs and goals. Look for gilts that balance income and tax-free growth. A strategic approach here can boost your after-tax returns. This is where direct gilt investing really shines. If picking individual gilts sounds overwhelming, consider a bond fund. Bond funds pool money from many investors and are managed by professionals. They invest in a mix of gilts, other government bonds, and corporate bonds. The main benefits are simplicity and diversification. Your risk is spread across many bonds. You don't need to be an expert. The fund manager handles everything. Funds can react quickly to market changes, which is hard for individuals. There are funds focused on UK gilts, global bonds, or a mix. Choose one that matches your risk level and investment goals. Bond funds are a great entry point for beginners. They offer easy access to the bond market without the complexity. Bond funds are convenient, but there are trade-offs. You pay annual management fees, which reduce your returns over time. Unlike individual gilts, funds don't have a maturity date or guaranteed payout. You could get back less than you invest. The value of your investment fluctuates daily with the market. On the plus side, funds offer broad diversification and professional management. Fund managers can balance risk by mixing different types of bonds. Tax treatment is less favourable. Profits from selling fund units are subject to capital gains tax, and income is taxable. You lose the special tax-free capital gains benefit of direct gilts. Weigh the simplicity and diversification against higher costs and less tax efficiency. Choose what fits your needs and tax situation best. Should you buy gilts directly or use a bond fund? It depends on your goals, tax bracket, and how hands-on you want to be. Direct gilts are great for higher-rate taxpayers seeking tax-free gains and willing to do some research. Bond funds suit beginners or those wanting simplicity and instant diversification, despite higher fees and less favourable tax treatment. Both options can add stability to your portfolio. Think about your priorities: tax efficiency or convenience. Align your choice with your long-term financial plan. The right approach will help you achieve steady, secure returns for your future.